5 stocks that we are looking at on our watch list. Spoiler alert, Mo and I own 2 of them. Stock number 1, Starbucks. So Starbucks has a big plan for some growth, I believe. Don't they, Mo? Isn't there something about that?
Really?
I don't know, but I look at this, it's a $110 billion company market cap wise. So you bought all the shares, 143 enterprise values. The difference is debt. They pay a decent dividend, definitely above the market of 2.2%. Eats up 2.4 of last year's 3.7 billion in cash flow.
That's a lot.
In the last 5 years, they've had 2.8 billion in cash flow. Now, one thing I also don't like, net income is higher than cash flow. Could that be because as they open more stores, they have to depreciate it, so it hurts their cash flow day one, but they don't see the recognized depreciation for a few more years in full. That could be it.
Possible.
That is possible. Do you see that return on invested capital? That's huge.
Yep.
Yeah. So what do you have on Starbucks? Any news about them?
Yeah. Fourth quarter revenue was up 11%.
Wow.
Comparable store sales were at 8%, 5% internationally.
Wow. So same store sales being stores that have been open 12 or more months. Every company has a different definition of it.
This is a good one. Usership of their loyalty program, their app, was up 14%, 32.6 million
wow.
people on that.
Wow.
That's a lot. Or accounts made, whatever.
That's incredible.
That's a lot.
Okay. Analyst estimates.
Buying back some shares.
They have earnings per share over doubling in the next 4 or 5 years.
Okay.
That's incredible. Revenue, high single digits, low double digits also. Good revenue growth, according to analysts. And let's go to the stock analyzer and see what we did in the past, Mo.
You have a watch list price of 80, so do I.
Do you?
Yeah.
Let's see how we got there. Here's my watch list I did. Here's my stock analyzer I did on August 15th.
What'd you put in?
6, 9, and 12% revenue growth.
I did 4, 7, 10.
Okay. 10, 11, and 12 for profit margin and free cash flow.
I did 8, 10, and 12.
Okay. And I did 16, 19, and 22 for both PE and price to free cash flow.
I did 18, 21, 24 for both of those.
Yeah, I don't blame you for that because it is a big brand.
It's the brand.
And then desired return 10, 12, and 14.
Yep. Same here.
And we still got pretty much the same number. Actually, yours is lower than mine. I have a mid price of 77. That's why I added 80. So I can start selling some puts at lower prices. So we got some ways to go, but it wasn't too far off.
Yep.
Right?
Yep.
Okay. Company number 2, the Googly Moogly. Google skyrocketed 141 per share.
It was just 130 on Wednesday.
Just 130 on Wednesday. Correct. Is that what it was? Literally? In the last 1 week, it's up 6%.
Or Thursday. Thursday, it hit 130.
So 6 days ago.
Yep.
Year to date, up 58%. January 6th of this year, it was at $85 a share. I still remember doing a video at 150 2 years ago, and we said we'd want to buy it under 100, and people said it'll never go under 100 again. It was at 85 just earlier this year. Higher free cash flow than net income, which I love. Big return on invested capital. They own 85% of worldwide search. 85% of worldwide search. I want to repeat that. 85%. The top 2 search engines in the world are Google and YouTube. That's essentially the case. And YouTube is owned by Google. So you're here on a Google platform, of course. Good profit margin, good gross margin. What do you got on them, Mo?
Let's see here. Revenue was up 11% year over year. Most of the growth has come in YouTube ads and search with cloud appearing to grow as well. Let's see. That's really the big highlights there. And then, of course, they're getting into AI.
Of course they are. Everybody's getting into AI.
AI Bard.
And as time's gone on, my assumptions for Google have changed for the better because I value a better quality company. Last time we did this was on December 14th, just 6 days ago. Here are my assumptions: 5, 8, and 11%, 22, 24, and 26% for both profit margin and free cash flow margin. I did a PE of 20, 23, and 26. Like I feel to myself, like, why am I not willing to pay more for Google?
Mm-hmm.
Right? Desired return, I went lower on the low side, 9, 10.5, and 12. Because I'm okay making 10 or 11% on Google. And look at, if you believe this stuff, Mo,
yeah,
it's there.
Right.
So am I just being too greedy at 120?
Maybe.
Maybe so.
I got 130.
Maybe I am being too greedy. All right. Stock number 3, Cisco.
Nice.
Why do you say nice?
I want to own this one.
Do you?
Yeah. They figured out their supply chain issues that they were having with all their hardware. They're back.
And look at their cash flow difference to net income. It's huge, Mo. 17.5 billion last year versus 13.5 billion net income. Guys, I keep stressing this because most companies are flipped. This company generates more free cash flow than net income. That's awesome. Their 5-year average free cash flow is 15 billion versus 11.6 on net income.
Like, how integrated is this company into American businesses?
Well, how integrated was AT&T? The difference is I like the debt level here.
Yeah, the difference is this is a good company.
Yeah. So guys, good return on invested capital, 17%. Their debt is the difference between market cap and enterprise value, only $30 billion difference. So they can basically pay it off in 2 years. I mean, let's look at their 8 pillars here, Mo. 8-pillar thriller.
Nice.
Huge stuff. I have it on my watch list, sub 40. I mean, one can make the argument for this.
Mine's 45 right now.
One can make the argument for this. You know, this is the kind of company, guys, where even doesn't have a lot of growth potential. What I want them to do is buy back shares. They pay a dividend, I assume.
I think
Stop that dividend, buy back shares. It's cheap. Keep buying back shares. Hope the stock goes down. Keep buying back shares.
So it looks like they have an $11 billion program out there to buy back shares. They've repurchased 1.3 billion, average price $54.50. They have 9.7 billion left.
They stopped? Oh man, why are they stopping?
They just had their first quarter in history with 8% revenue growth year over year, earnings per share up 37% year over year, total software revenues up 13%.
I want to remind everybody, 23 years ago, Cisco was the first company to hit half $1 trillion in value. They said it was going to be the first one to hit $1 trillion. And here we are, 23 years later, it has never gotten above that point, and it's currently at a $200 billion market cap. Why? Not because Cisco did a bad job. Their revenue went up, their profit went up because of overvaluation. The market assumed too much, and it didn't come through. That's just it. Stock number 4, a company that I own, Southwest Airlines. Remember, guys, don't ever buy a company just because somebody on the internet says it. And I fully expect every stock I own to go down and buy more of it as long as my thesis stays the same. If you're looking for somebody to give you a stock pick, we're not the channel for you. If you're going to gauge our results on 1-month results, we're not the channel for you. We're here to teach a process. I like Southwest for a few reasons. My main thesis is, look at their profit margin lately, 2% and 2.2. Let's go to before COVID. Annual basis, their profit margin on $22 billion in revenue, they did 2.3. That's 10%. $22 billion in revenue, they did 2.4. That's 12%. $21 billion in revenue, they did 3.36. That's 15%. Do you see my point here? Mo, what are you looking at?
Why is this company paying a dividend?
Yeah, I don't know.
I had no idea that I own this company and I didn't even know they paid a dividend. That's just absolutely stupid.
It is dumb. They should be buying back these shares like crazy. I don't look at the PE and price of free cash flow here. These are useless to me. Because I look at this saying, okay, great. They're on completely just terrible profit margins. 80% decrease from before COVID. In fact, some places it's almost 90% decrease. So I'm saying, okay, listen, once the gross profit goes back up to 30 to 33% where it was before, they're going to be able to drive that profit margin to 10%. That is my thesis. Could I be wrong? Absolutely. To me, it's the best run airline out there. So I'm attaching myself to it. Go ahead, Mo.
Record Q3 revenues of $6.5 billion. That's a 4.9% increase.
Wow.
Over the previous. That's great.
Travel's back.
Yeah, clearly.
So that's my thesis on them. I do think I'm going to pull up my previous stock analyzer tool. And guys, before we go further, we engage a lot in the community. We talk about the software a lot. There's all these other tools here. So if you're interested, we have a 7-day free trial. Go to everythingmoney.com. 7 days, full access, free trial. You get everything, all these tools, the full community. Go sign up there or just go check it out. So we did analysis, and these are my numbers. They came up all green again. If you believe these, remember, you have to believe these because if you don't and you buy the stock and it goes down, you're not going to know what to do. So do your own research, understand that. Stock number 5, final stock, American Express. I own some of it. Mo does not.
Nope.
So let's see where American Express is at right now.
Let's see.
It's the leader in luxury credit cards, right?
Yes.
100.1% gross margin, sick.
Solid.
Let's see here. 15% bottom line margin. Revenue of $58 billion. Free cash flow of $18.5 billion. Their net income was $8 billion. 5-year average free cash flow, $11.5 billion. Their net income in the last 5 years was 6.8. They're selling for single-digit price of free cash flow. Decent return on equity. Return on invested capital, 11.1%. High return on equity. I'll Apart from the debt, it's a 8-pillar stock. I have my watch list sub 140. I think I can justify a little bit higher than that, but it's currently at 185. I bought it sub 140. If you look at the 1-year chart, Mo,
Skyrocketed.
yeah,
As per
year
usual.
to date, it's up 27%. Its low was, oh, actually, the 52-week low was, the 52-week low was 140. I did
Okay.
buy it before December of last year.
Okay.
It got as low as $63 back in March of 2020. Wow. Back in September of 2022, it was at 132 as the low. Interesting.
Revenue up 13% year over year. Earnings per share up 34%. But provisions for credit losses up 58% year over year. They've increased from
Okay.
1.2 billion in 2022 to 3.5 billion.
I want
today.
everybody to understand what that means. They're sitting there saying, listen, credit cards, we're going to have more losses than before, increased by 58% their provision for them. So they sit there and say, listen, before we wanted hypothetically $100 million in provisions, now we want 158 million. This is part of my concern about the economy. I see these credit cards increasing. I see delinquencies increasing. That's my concern. But I still think American Express is in it for the long haul. You should hope for a recession. It'll probably affect American Express greatly. The stock will go down. Thank you very much for your time.